Welcome to the Consumer Financial Protection Bureau's forum entitled Know Before You Owe, Closing Time, which is being live streamed from the Bureau's headquarters in Washington, D.C. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Ixta Martinez. I'm the Associate Director for External Affairs at the CFPB. Today's Know Before You Owe forum is being live streamed on our website at consumerfinance.gov, and you can follow CFPB on Facebook and Twitter at #eClosings. That's #eClosings. Today's forum will feature CFPB officials, senior federal regulators, as well as industry and consumer group representatives and practitioners. Let me spend just a few minutes telling you about what you can expect at today's forum. First, you'll hear from CFPB's Director, Richard Cordray. Following Director Cordray's remarks, you'll hear from senior representatives of the Federal Housing Administration, the U.S. Department of Agriculture, the Department of Veterans Affairs, and the Federal Housing Finance Agency. This will be followed by a panel discussion that will be moderated by Norena Limon, CFPB Policy Analyst and Project Lead for the Know Before You Owe Closing Time Initiative. The panel discussion will be followed by remarks from the Secretary of the U.S. Department of Housing and Urban Development, Sean Donovan, who is en route back into Washington, D.C. If the Secretary's flight runs a little late, we'll move right into the audience participation portion of the forum. So let's get started. I'm very pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, Richard Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you. Now, if you start clapping for all the speakers today, we're going to be here a long time. Thank you all for joining us today. It's a very high-quality group, I noted on my way in. We've convened this forum to discuss one of the most significant yet stressful times in the lives of consumers, mortgage closing time. Mortgage closing comes after the neighborhoods have been scoured. Schools have been evaluated. Countless websites have been perused. Wish lists were made and deal breakers were considered. But finally, a home has been found. An offer was made and accepted. The consumer has applied for and been approved for a mortgage, hopefully after careful shopping and thoughtful evaluation of the future. Now it is down to the final hours before the consumer can take ownership of the new home, and standing between the consumer and those keys is a mountain of paperwork. The paperwork may be full of legal jargon and seemingly senseless acronyms. In the words of one consumer, the print is font size fly speck, and the language is boilerplate. Without a doubt, the mortgage closing process is complicated for everyone involved and is most stressful of all for the home buyer. At the Consumer Financial Protection Bureau, we're working hard to improve the home buying and home ownership experience for consumers. We know a mortgage is often the biggest financial commitment that people will ever make. We also know that it is much more than just a financial transaction. It creates a special place to establish roots, to share with family and friends, and to take refuge. It becomes closely tied to one's identity, a place of one's own, not simply a house, but a home. It also marks a rung on the economic ladder, a key step toward improving one's lot in life. Knowing this, we've taken action to address problems in the mortgage market and protect consumers. We saw too many people slip back down the economic ladder when the financial crisis hit. The collapse of the housing market destroyed businesses and jobs across every economic sector and in communities all across the country. The American dream of home ownership was shaken to its core. Home values plummeted, household wealth shrank, and the effects still haunt our economy today. Central to our mission at the Consumer Bureau is promoting stability in the marketplace to help ensure that such a crisis will never repeat itself. So last January, we implemented new rules to improve the functioning of the mortgage market. We took a back-to-basics approach founded on three main tenets: no debt traps, no surprises, no runarounds. Our rules prevent creditors from extending loans to consumers who lack the ability to repay them, requires new disclosures, and mandates better customer service. In November, we took further action to improve the mortgage experience for consumers. We finalized a rule requiring easier-to-use mortgage disclosure forms that clearly lay out the terms of the mortgage for a home buyer. In fact, just this week, these new forms led to the Bureau winning the Center for Plain Language's Grand Clearmark Award for clear, concise communication. The forms were selected from a range of submissions from private industry, nonprofits, and other government agencies. The new Know Before You Owe mortgage forms will replace the existing federal disclosures and help consumers understand their options, choose the deal that is best for them, and avoid costly surprises at the closing table. The goal of all these efforts is to give greater control to consumers so they can take charge of the decisions they're about to make and take a more active role in their closings. Today's discussion of the closing process is the next step in our Know Before You Owe initiative. We're unveiling new research on the challenges that consumers face in the closing process and in identifying potential solutions. One of these potential solutions may be found in the e-closing pilot project that we're announcing today, and you will hear more about that in a few moments. But first, we can motivate the topic by offering more detail about people's real-world concerns. Mortgage closings are often fraught with anxiety. In December, with an eye toward improving the closing process for consumers, we sought comments from the public on the pain points they've experienced in the mortgage closing process. We heard an earful about three main challenges: lack of time, too much paperwork, and forms that are complex and confusing. The first issue we heard about was that consumers are very frustrated by the short amount of time they have with the closing documents. Most often, consumers do not see the paperwork until they arrive at the closing table. They feel pressure to rush through the paperwork and sign without understanding the terms of the deal. In interviews, we heard that many consumers said they do not manage to read most of what they're signing. Even those who said they start off reading the documents confess that they stop reading by the end of the stack. As one consumer put it, "Whatever they were putting in front of me and explaining, I just signed." Of those who did read the documents, one borrower told us, "When I showed up and announced that I was going to read all of them, I received eye rolls from the assembled attorneys and real estate agents." Such a substantial financial commitment should not be treated this way. Fortunately, we've already taken action here to help consumers. Starting in August 2015, consumers must receive their closing disclosure form at least 3 business days before they actually close on the house. And we put in place new protections that prevent lenders from changing the terms of the deal by the time consumers get to the closing table. But the closing disclosure is just one of the documents included in the stack of paperwork. We want consumers to have plenty of time to review all of the documents and raise any questions they may have. The ability to spend time with the closing documents is one challenge we heard about. Another is the huge amount of paperwork. The sheer volume of the documents can be overwhelming, especially coupled with the short time frame. On top of that, the volume varies from transaction to transaction because closing documents and practices are not uniform. 2 people could be closing on the same type of loan for the same amount in the same location, but one may have only 40 pages of documents while the other has 100 pages or more. The only difference may be the lenders they use. In some closing stacks, we found that a number of documents were actually added by the lender. Some of these forms are intended to help consumers better understand the costs and risks of their mortgages. Others were devised by lenders as defensive measures to minimize the prospects of future litigation. Still others represent federal, state, and local government requirements, some of which may have become outmoded over the years. The undeniable result is information overload. People find that there is just too much to absorb during the closing process, which may cause them to shut down altogether. Industry members agreed as well. One settlement agent told us, "There are far too many redundant papers, and it is overwhelming for most borrowers." There's so much to digest in the stack of paperwork and so little time to go through it that many borrowers do not even bother trying. Those who do try to read all the documents face a third challenge, a lack of guidance in how to understand them. The closing stack is full of impenetrable legalese and jargon. The terms and acronyms are foreign to most consumers, like they're reading another language. But many consumers complained that they had little help from the others in the room. One consumer gave this account of dealing with a settlement agent. Sometimes when I asked for an explanation of a form, he would blow through it. As a result, home buyers end up signing documents without properly understanding or evaluating the most critical information. One home buyer simply said that the stack of documents felt like you're signing your life away. These new homeowners leave the closing table with a whole new level of anxiety as they find themselves wondering what was buried in the stack of paper that may create some nasty surprises in the years ahead. We are convinced that we can make important improvements in the closing process. Our new closing disclosure form helps address some of these issues because it is shorter, and consumers have told us that it is much easier to use and to understand. We believe the e-closing process may allow this form to stand out even more for consumers than if it's buried somewhere in a mound of paperwork. But more needs to be done in the long run as well. The Consumer Bureau itself has authority over only a few of the items in the closing stack. The rest will require other stakeholders to make a commitment to help effectuate change. And everyone involved needs to embrace the central idea that consumers should feel empowered and not undermined by the closing process. So as part of our Know Before You Owe initiative, we're making a commitment to work with the various stakeholders to use technology in order to improve the mortgage closing experience for consumers. We strongly believe that electronic closing solutions, known as e-closings, can lead to more knowledgeable consumers and a much better process for everyone involved. There are several ways that e-closings can pave the way for a more efficient process that is also more empowering for consumers. Electronic documents can make early delivery more convenient and simple, giving the consumer time to read the documents, consult with family members or professionals, and ask the lender questions. Electronic documents can also provide an opportunity to embed links to educational materials for consumers, allowing them to reference these materials while they're reviewing the documents both before and during the closing. And shifting to an electronic process should lead to greater consistency and accuracy, since automated processes can make it easier to detect discrepancies. We've heard repeatedly that errors and delays are a big source of consumers' frustration, so anything that can be done to mitigate that problem is a welcome change. By spurring the adoption of e-closings, we can also reduce costs. It's faster to send documents between lenders, investors, or other stakeholders electronically than it is to send those documents by mail or other means of delivery. The time saved can translate into tangible monetary benefit for lenders. According to a leading title company, a typical mortgage closing generates about 6,000 pieces of paper across all stakeholders from start to finish. The paper and storage costs for this title company alone amount to $20 to $30 million annually, costs that can be significantly reduced through automated processes. As this particular organization is moving to electronic documentation, their annual paper and storage costs are steadily being reduced. Some of these potential cost savings can and should be passed along to consumers. But we also know that innovation can create new risks, just as exotic new mortgage products help precipitate the financial crisis. So we do not want innovation to come at the expense of consumers. Any electronic closing process that diminishes their ability to act in their own self-interest will raise serious concerns for us. Merely switching to an electronic process may not increase the amount of time consumers spend reading and understanding the documents. Instead, they may simply click through the documents just as they typically skim through the closing stack. But we aim to incentivize e-closing processes that will give consumers the opportunity to review documents in their home in advance, along with educational materials to promote greater understanding, while still retaining the option of reading them at the closing ceremony where the final and most crucial decisions are ultimately made. We have heard some concerns about data security and the risk of fraud with people using e-signatures that are not their own. Nevertheless, the federal government and every state have weighed the same concerns and adopted laws that approve the use of e-signatures. We would also be concerned if e-closings meant that consumers could not freely and easily access a full record of the documents they signed. But there's no obvious reason why this should be a problem, and lenders can easily establish a repository of electronic documents for each closing. Finally, this process should not be designed in ways that deprive the consumer of control over decisions and judgments that might have to be made at the last minute about this life-altering transaction at the closing table. In short, we want to encourage an e-closing process that helps consumers rather than harms them. We're committed to working with industry and consumer advocates alike to find the best way forward. Over the next 15 months before our Know Before You Owe rule goes into effect, we're proceeding deliberately by launching a pilot project. Some lenders are already offering e-closing solutions. We'll hear some about that today. We plan to work with them to explore how we can best facilitate and secure the benefits of this new and improved approach. Today, we're releasing the guidelines for our e-closing pilot program, which we will launch in the coming months. The pilot program will assess and advance electronic closings and test our vision for additional educational tools that can be incorporated to benefit consumers. Our goal will be to determine how the e-closing process can be made to reflect the spirit of our Know Before You Owe rule by generating increased consumer understanding, fewer surprises at the closing table, and a more empowered consumer. This is not a rulemaking process. Instead, it's a potential win-win effort to work with all stakeholders to ensure that consumers understand the commitments they're making and experience a more transparent, efficient, and effective process. To help manage the scope of the first phase of our project, participants in the pilot program must already have a process in place and be currently offering an e-closing option to customers. Those who are interested should begin by reviewing today's guidelines and the procurement document, which is known as a broad agency announcement, for details on how to apply. On our end of the program, we plan to test educational tools along with materials like document summaries, term definitions, process explanations, and checklists that consumers can review prior to the closing. We want to see what helps consumers become more informed and in control of the process. We also want to know whether the order of the documents changes the consumer experience. We're interested in studying and testing the various technologies that would let consumers see the entire package of closing documents ahead of time. Ideally, they would receive the complete set of materials at least 3 business days before closing. We want to know how spending extra time with the documents affects the process. Do consumers feel less pressure? Are errors less common? Does the process create more satisfaction for each of the stakeholders? As we address these questions, we plan to identify best practices that we can share industry-wide to the benefit of consumers. We will use the results of the pilot program to foster a high-quality dialogue about the merits of e-closing. The program should get underway sometime this fall. The mortgage and real estate markets involve many players, so we will need to work together to bring about the positive change that we're envisioning today. I would also like to take a moment and applaud those agencies and officials, some of them here today, who are already finding ways to make the closing process easier for consumers. From their efforts to allow electronic signatures, to offer affordable loans, and to counsel potential homeowners, they're playing an instrumental role in this process, and we're glad to have the chance to work with them to deliver value for American consumers. From the first days of the Consumer Bureau, our Know Before You Owe project reflected our deep commitment to making markets work better for consumers, for responsible providers, and for the economy as a whole. The vision we all share is to build a sustainable marketplace in which consumers can once again put their trust. We know how much they deserve it, and we look forward to our discussions today to see how we can do just that. Thank you.
Thank you, Director Cordray. Our next speaker is Tricia McClung. She is the Acting Director of Single Family Program Development at the Federal Housing Administration. Ms. McClung?
Director Cordray and everyone here today, thank you so much for including us at FHA. I am Acting Director of Program Development and Single Family at FHA, and we're very excited to see the continued advancement of not only the use of technology, but hopefully more effective means of working together as an industry and working to improve the overall mortgage process. I will tell you that one of our main goals at FHA right now is trying to find more and more ways to make it easier to do business with FHA. We serve a lot of underserved markets, and we serve a lot of harder to serve borrowers in some ways. And certainly the one thing we want to do are find ways to make the process more efficient and effective as we continue to improve and create more access to credit in a responsible and effective way going forward, something that both the consumer and the industry can trust as a long-term perspective. As part of that, back in January, at the end of January, we announced an expansion of our e-signature program that's very complementary, I think, to the things that are going on here in the e-closing space. We have accepted some e-signatures from before. We accepted them in third-party signatures and other areas, but we've really expanded it to include just about everything, particularly in our Title I and Title II forward mortgage space. We don't include everything yet on the HECM space, but in Title II forward, just about everything. The one exception to that in the near term is the note. We're working in partnership with Ginnie Mae on that. The note itself makes a bit of a difference between going from an electronic close or electronic signature to an electronic mortgage, and many of you here are probably very experienced in that difference as I described. So in the near term, though, everything that we've announced is currently effective, and so we do accept e-signature on a number of areas. Mortgage insurance documents that we produce and that the industry produces, servicing and loss mitigation documents, insurance claim documentation, and real estate owned documentation. So we really consider the electronic signature initiative very broad in scope and encompassing of nearly all the documents that can do business with us, and we consider it to be a very viable alternative to the wet signature across the board. So we're very excited to be a part of this and just wanted to share with you the piece that we're focused on at this point. Thank you so much.
Next, you'll hear from Joaquin Tremos. He is the Director of Rural Development's Single Family Housing Guaranteed Loan Program at the U.S. Department of Agriculture. Mr. Tremos?
Thank you, and thank you for inviting USDA Rural Housing to participate in this public forum. Briefly, I'm the director of the Guaranteed Loan Program at USDA Rural Housing, and it's a no-down payment program for low and moderate income households in rural areas. And rural areas means about 90% of the United States. I have a small group here in Washington, D.C. Our job is to develop policy, write regulations, monitor our portfolio performance. We have about $100 billion in outstanding guarantees, monitor the lenders that make and service these loans, and to develop automation, which is something I'm going to talk about. When it comes to e-signatures, our regulation does not prevent them, and it does not specifically accept them. But our position is it's up to the lender to perfect a mortgage, a security interest, and it's up to the lender to establish a promise to pay. And if they do that, everything will be fine. And if they don't do that, we might not pay a claim if it comes to a loss. Automation. We have a full-service automated underwriting system. We call it GUS. That's for Guaranteed Underwriting System. And we've just developed an automated loan closing that we started rolling out on July 30th. And let me describe the old way. The old way, the lender would close the loan, photocopy a bunch of documents, cut a check with our guarantee fee, and put it in an overnight envelope and send it to the agency. And the agency would open that envelope the next day. They would make sure that the check is for the right amount. They'd fill out a form. They'd put the check and the form in an envelope to a lockbox. And that is the old way. Oh, and then if everything was okay, they would print out a loan guarantee, sign it, and get it to the lender. That was the old way. The new way is that the lender transmits the loan closing documents electronically to the agency. They pay the guarantee fee through pay.gov. It's an electronic payment. The system will check if it's for the right amount. The lender will get an error message if it's not. And if everything's okay, they'll get an email from the agency saying, you can download your loan note guarantee by following the link below. The agency's not involved in that anymore unless problems arise. It's a lot faster. The lender saves on that overnight fee, and we're very proud of it. If some of you are closing guaranteed loans in rural areas under this program, please avail yourself of this technology that we have made, that we put out. And that's it for me. Thanks again.
Next is Michael Frew. He is the Director of the Home Loan Guaranteed Office at the U.S. Department of Veterans Affairs.
Thank you. Especially thank you to Director Cordray for having us here. And as everyone on my staff at VA knows, I don't like it when government agencies do things alone. It's really nice to have this sense of cooperation. And since CFPB is right down the street from our office, it's a very easy meeting for us to come to. Since 1944, VA has relied on a very, very strong public-private partnership to deliver our benefits to millions of veterans across the world. In fact, we just hit our 20 millionth loan last year, which is about $1.5 trillion worth of loans guaranteed, none of which were made by us. We don't make loans, we guarantee them. And compared to FHA, we guarantee a tiny little portion of them, and USDA as well. We have a 25% guarantee. So it's essential to our success as an agency in delivering benefits to veterans that we find a way to appeal to an interest in lenders. And one of the things that we've been very, very good at, I think, in the last couple years is making the process easier for our stakeholders. To that extent, we've been working a lot with lenders, with servicers, with various government agencies. We have a joint task force among all the big housing agencies to talk about common interest and common solutions. We talk to NAR and MBA and NAMBI and others in the mortgage industry to try to find ways to meet a need. If we're causing an impediment to a loan closing, we want to get it out. We want to let lenders do what they do best, which is lend. We're just trying to encourage it with a guarantee. So we work very hard to make the process transparent, quick, and painless because we have that sacred trust with our veteran borrowers and service members around the world. We want to make sure they get a loan that they're able to keep and they can maintain throughout the life of the time that they want to stay in that loan. e-sign was enacted in, I think, 2000. And ever since it was enacted, we, like USDA, have allowed e-signatures on any document that's allowed to be signed electronically. We haven't wanted to impose any restrictions on it because it's a law that we believe in, and we think it actually promotes the liquidity in the market and the ease of closing. And to that extent, it matches with our goal exactly, which is what can we do to enhance the closing process or to make that process easier for borrowers. Additionally, we have one added aspect to it that was very keen to us. We have about 17% of our loans are made to active duty service members. Some of them aren't anywhere near the closing table at the time of the closing. E-signatures allows them to sign their own mortgage documents themselves rather than letting someone else acting through a power of attorney sign their mortgage documents in absentia while they're over wherever they may be at this point in time. To ensure lenders that understood that e-signatures are acceptable to us, we actually created our own circular. I think Tricia had hers with her, and ours is a very simple one. It's about one paragraph long. It's very small. It basically says, if it's in accordance with the law, you can do it. We're not requiring you to do it, but if you do it, just follow the law. The same thing that we believe with RESPA, with TILA, with Dodd-Frank, everything else, there's a whole set of laws and local restrictions, local law, county, city, state that are in effect with every real estate transaction. We expect lenders to comply with it and do whatever they do. What's their special sauce that they add to the process to make them better so that they're serving our veterans in the way that we want. And we just want to make sure the whole process is seamless. So we succeed when our lenders succeed. I think that anything that we can do to enhance the process of helping lenders succeed, we're on board 100%. We're very happy to be here, and thank you very much.
Next is Meg Burns. She is the Senior Associate Director for the Office of Housing and Regulatory Policy at the Federal Housing Finance Agency.
Hi, I want to echo the thank you to the CFPB and Director Cordray for having FHFA here today. We actually work very closely with Fannie Mae and Freddie Mac, and there are representatives from both companies here today, so I will leave the details to them. They are experts in this field. But I want to say that we have a long history of supporting efforts in the space of data standardization, creation of electronic forms and files, acceptance and storage of electronic documents. And I'm going to talk a little bit about some of the history and some of the current efforts underway. But I want to make sure that I say that we really applaud CFPB's efforts in this space, and particularly I want to call out the very collaborative approach that CFPB has taken to pretty much everything that they do, but certainly in this space. We think it's really impressive to have a gathering here of industry and federal representatives to have this kind of a dialogue. So thank you for that. And we think that these efforts are actually, frankly, critical to market recovery, to advancing housing finance reform, whether or not there's ever legislation. So we think this is a really key effort underway. So quick history, Fannie Mae, Freddie Mac, and FHFA worked together on something called the Uniform Mortgage Data Program, starting back in 2009, 2008-ish, probably some of the ideas were conceived by Fannie Mae and Freddie Mac. And these efforts were really designed to improve some of the data collection at Fannie Mae and Freddie Mac. As a first step, they took the Uniform Residential Appraisal Report, rethought the form itself, standardized the data fields, the data definitions, the definitions behind those fields, and sort of the values that would go into each field in order to create the uniformity that was necessary to really use those forms for the benefit of all. They also created a portal to receive those files electronically. They, at the same time, also thought through the other delivery data that they needed as companies to make their own securitization decisions, and they created some uniformity in that space. At that point in time, these efforts were very GSE-centric, which was fine, but now we're moving into a different phase where we're really trying to be more thoughtful about what are the needs of the industry as well. And in this new phase, one of the efforts that took place this past year was working with the CFPB on the new closing disclosure form, which was a really collaborative and fantastic effort to, again, think through the fields on the new form, how to define each field in a uniform way, create a set of data standards that was consistent across the industry. That was, we think, a very beneficial effort for everyone, not just the consumer, but for the industry as well. We also are now going through that kind of effort with the loan application form, the Uniform Residential Loan Application. We're actually working with all of the federal agencies who are represented here today to rethink some of the fields that are on the form and, again, to create a standard data set. For us, the benefits to the consumer that were already highlighted here today are obvious. The additional clarity, the efforts to streamline the process for consumers is great. But we also see a tremendous benefit for the industry in terms of improving and expanding risk management practices and capabilities, in terms of improving the sort of integrity of the process, the quality of the information that's collected, and ultimately, we think that this will advance our efforts again in towards market recovery, improving the housing finance system as a whole. So we feel very positive about all of these efforts. So thank you for inviting us here. That's all.
At this time, I'd like to invite the panelists to take their seats on stage. And while they do so, I'll introduce them. The panel includes Christos Betios, Chief Information Officer for Mortgage Services, First American Title Company, Michael Cafferkey, Senior Product Manager for eMortgages, Fannie Mae, Ann Epstein, Product Development Director for Single Family Sourcing and Servicing, Freddie Mac, Michelle Korsbo, CEO, American Land Title Association, Amy Moser, Vice President of Mortgage Services, Mountain American Credit Union, Margot Saunders of Counsel, National Consumer Law Center, Stephanie Shader, Program Development Manager, Ginnie Mae, David Whitaker, Counsel, Buckley Sandler, Quintus Williams, EVP of Operations, Long and Foster Settlement Services, and also representing the National Association of Realtors. Norena Limon, who is the CFPB Policy Analyst and Project Lead for the Know Before You Owe Closing Time Initiative, will moderate the panel. Norena, you have the floor.
Thank you, and thank you once again for all of our panelists for joining us today. So we'll allow for each of you to give brief introductory remarks. So if we can start with Christos.
Great. Hello. And first, let me also take my turn to thank the leadership of the CFPB and Director Corderay for putting together this important event. I think, being a long-time e-closer type, I always appreciate the invitation. So when we look back at the original days of e-signing and today, what comes to mind for me is that what's old is new again, right? The drivers back in 2000 when we were pushing for this were shorten the cycle and reduce the borrowing cost for the consumer, eliminate errors and reduce the cost to originate, and then gather more data so we can do analysis. We'll add compliance to it, and that's where we are today. So I think what we saw back in the early days, we saw some visionary leaders who stepped up on the lender side and took advantage of what was then a very important event, the e-sign legislation. So today, I believe we have another, watershed moment, right? A big opportunity with the CFPB integrated closing disclosures for leaders at the lending community to look at this not as an IT project, but rather as an opportunity to approach the implementation of the CFPB disclosures as an opportunity for improvement and not as a project. So you have 15 months, the director said, and I think 15 months is a great opportunity to put together solutions that are e-enabled and can drive the same benefits. So we are at a point where I think lenders should look at the opportunity. And so at First American, we had an opportunity to also talk to CFPB about this. We're showing our lenders how an interactive closing disclosure can be completely electronic, allow the parties to participate and collaborate, and then share the data in the forms of the consumer 3 days in advance and have electronic signatures. So our consumers, our lenders are interested in participating in some, and hopefully some of them will sign up for some of the pilots that the CFPB is pursuing now. So that's my opening remark.
Thank you, Christos. Amy Moser?
Yes, I'm Amy Moser with Mountain America Credit Union. Mountain America is a $3.9 billion credit union serving 5 western states. We are 100% paperless from origination to closing. That's my opening remark.
Thank you, Amy. Mike Cafferty.
Thank you very much. Again, I want to echo the thank you to Director Corderay and the folks at CFPB for arranging this session and really for the focus that you're putting on e-closing and e-mortgage. I've been involved in Fannie's e-mortgage initiatives now for over 8 years, and I've definitely seen how technology and electronic signatures can really transform the closing experience to something that's not only much more consumer friendly, but also provide tremendous benefits to lots of other stakeholders, to lenders, to realtors, to closing agents, and to ultimately investors. And so, I applaud the effort in this initiative. I really feel, and I've been doing this for a while, and I know I've been saying internally to folks at Fannie that we're only a couple of years away from real adoption, and so I've probably lost a good bit of credibility over the years. But I honestly feel now that we're at a point where the stars and moon are aligning, and there's a lot of things that are going on that are really, I think, are starting to spur this transformation. Fannie Mae has been involved in purchasing e-mortgages now for over 10 years. We're still at a point, unfortunately, as everyone is well aware, that there's just been very modest adoption of e-mortgage and e-closings. And so why do I feel this sense of optimism? Well, I think there are a number of reasons. First of all, there's been a number of kind of building blocks along the way. When the IRS decided to start accepting the 45-6T electronically signed, that eliminated one obstacle toward a paperless closing, and that was very important. Certainly the FHA announcing an expanded use of electronic signatures on FHA loan documents was a huge step forward, and so I applaud the FHA and the work that they did to get to that point. There's a rapidly increasing number of recording jurisdictions now that are permitting electronic recording, and that's an important step as well. And so although there's a lot more recording jurisdictions that aren't ready, my understanding is that there's a vast percentage, like 65% of the households in the United States are in a county that permits e-recording. So huge strides there. and really an increasing comfort level with e-signatures in general. Consumers have certainly embraced electronic signatures and really have, in many ways, have come to expect it. And I think from the lender's perspective, there's kind of an increasing comfort that issues around enforceability of an electronically signed note have really diminished to a large extent. There's this increased focus, obviously, in the industry on compliance and the role of technology in order to be able to enforce and really demonstrate compliance, I think, is a really important element of this. And so we're starting to see, I think, increased focus on e-signatures as a way to really ensure and demonstrate compliance. And finally, we're starting to see more of the technology providers to the closing industry are starting to build in electronic signature capabilities into those platforms. And that's really a very important prerequisite to be able to perform e-closings on a broad basis. So I think all of these things together, I think, are contributing toward what we're seeing at Fannie Mae is kind of an increasing interest amongst lenders, amongst servicers of adopting e-mortgage. And so hopefully that will begin to show itself in terms of real-life implementations. I certainly understand that there's a lot of barriers that still exist that are in the way. We continue to engage with lenders and others in the industry to sort of understand those barriers and do what we can to eliminate them. But this sort of forum, I think, is fabulous. You know, I certainly appreciate the interest and the involvement here of CFPB in trying to move this forward. And maybe there's hope that before I retire that we'll actually get to broad-based e-closing. So thank you very much for the invitation.
Thank you, Michael. Ann Epstein.
So again, echoing, thank you for inviting us, and actually thank you also for the focus on electronic closing, because I do think it's important. And I do think one of the issues is there are many, many players in the mortgage industry, many players who have to touch, change processes and so forth. And so change requires systematic change, not just one lender, not just one investor, not just one warehouse lender. We need systematic change. And so the focus from a more global level, I think, is really, when I think of how we move forward, is really important. And, echoing the joke among many of the people here in this room is that e-mortgages has been 3 to 5 years out for forever. It actually isn't forever, and I checked in with Jim Newell over there, who's head of our legal department for single-family operations and technology, and he co-authored an article in the Idaho Law Review in 1993 with the concept of an electronic negotiable promissory note that was in fact the precursor to some work that he continued with Mike Gordon on the legal team and Dave Whitaker, who was then at Freddie Mac, to actually create eSign and UITA. So it's been 20 years, 3 to 5 years in the making, but I do think that it is in the process. And I think one of those reasons is because we're approaching it from a different angle this time. And so the note is great, right? The note is good and the security instrument, but also when we talk about the closing disclosure, that's an impetus for an industry-wide change. There is value to having that, even if it was just that document, be electronic. And when I say electronic, I don't mean a PDF version of a paper document. I mean an electronic document with data standards, the uniform closing data set that Meg talked about, underneath it, so we all know what it means. And the borrower knows what it means because there's standardization there. And I do believe that there is value to the industry in making that an electronic document. That will force the putting in place infrastructure that can then be leveraged for other documents in the closing package, and eventually we get to all of them. But I think this change with the new closing disclosure form will be a really important impetus for moving forward. So thank you.
Thank you, Ann. David Whitaker?
For me, thanking Director Cordray and the staff of the CFPB for beginning this initiative, having this forum today, is very personal, because as Ann has alluded to, in 2000, I swore that I would not retire until e-closings were common, and as you can see, the strain is starting to show. But when I began working on electronic financial services legal issues, which was now over 20 years ago, I and some of the colleagues I have been fortunate enough to work with, including Margot Tank and Jerry Buckley, Jim Newell at Freddie Mac, Kim Weaver, who is in the room, we were all intrigued, I know I was, by the potential that electronic records and signatures and their use in substitution for writings had as an opportunity to lead to more effective, efficient, and customer-friendly financial services transactions. And really, the hope for all of us as we worked on the creation of the Uniform Electronic Transactions Act at the state level, as we worked on the Federal e-Sign Act, as we worked on the standards and procedures for electronic records and signatures, a set of industry standards that are being used to this day, 14 years later. Our hope in all of that was essentially to facilitate realization of what we could see dimly, which was the possibility for a complete reformation of the way the average American financial consumer interacted with financial services products. Ironically, one of the first and most important drivers for that movement came from the mortgage industry and particularly from the GSEs. And yet, as we look today, we can see that across financial services, electronic records and services signatures have had an enormous impact, except in the post-application residential mortgage process. There are lots of reasons for that. The complexity of the transaction, the number of players, the need for interoperability. But what I am very heartened by is that I think that this event today essentially signals a new chapter. And I know Margot, who's here in the room also, we are very excited about the prospect that at the end of the day, we will not only see, as Ann has alluded to, that we will move perhaps paper documents to an electronic form, but that the use of electronic records and signatures offers us the opportunity to completely reimagine the way these transactions happen and how the purchaser of a home, who may do it only once or twice in their lives, interacts with this process. Thanks.
Thank you, David. We'll loop around. Stephanie, there, please.
Good afternoon. I'd like to echo the thank you to Director Cordray and to the CFPB for hosting this forum and for including us today. Like FHA, we're currently involved in some major initiatives to make it easier to do business with Ginnie Mae. As a matter of fact, until a few months ago, a lot of our own forms were still in paper format. So we're moving to electronic signatures in that space, and this is a natural next step for us. We're also working very hard in the uniform data space, like Meg was alluding to, as we work forward to adopting the MISMO data standard for our loan delivery data set. So I think we just recently announced that we're moving forward with that. So with that, I'd just like to say again, thank you very much for including us, and we look forward to the conversation.
Thank you, Stephanie. Margot Sanders.
Hi, I'm Margot Saunders. I'm the consumer advocates in the room. Apparently, there's just me, but I work for the National Consumer Law Center. Oh, sorry, I see some others back there. Great. I work for the National Consumer Law Center. We're a public interest law firm that has worked with legal services, attorneys, private attorneys, and state attorneys general and consumer cases for several decades now. And on the issues of electronic signatures, I'm the other Margot. There's Margot Tank, and I've been involved. And I'm the one usually called the troglodyte. Because while we congratulate the CFPB for moving forward on this issue, and we recognize that electronic closings will be very helpful for many people like the people in this room who have the sophistication and the wherewithal to read the documents, understand what they read, and then go out and negotiate about what they read. E-closings will not help many of the problems that were cited that are still going to go on with closings. Lack of understanding of what's going on, lack of the ability to appreciate the risks of the documents. And so as we move forward with electronic signatures and electronic closings, I hope that you recognize that this might, unless carefully tailored, be a vehicle for fraud against those consumers who are not sophisticated. I want to remind you of one statistic that those of us in Washington tend to forget, that the whole world is not yet hooked into the web. According to the latest census report, only slightly more than half of people over 65 have any access to the internet. Only 55% of Hispanic households have any access, and the statistic is for households, African American households, it's 58%. So for those households, this will be great. But please don't create a system that will be so much less expensive that the people on the other side of the digital divide will be disadvantaged.
Thank you, Margot. Michelle Corsmo?
Hi, I'm Michelle Corsmo. I am the CEO of the American Land Title Association. We represent 4,800 and some odd title insurance and settlement companies, including abstractors, real estate agents, I'm sorry, not real estate agents, title agents, title attorneys, and title insurance companies. And I think, Margot, you'll find that we share a lot of your concerns about making sure people understand the process. So as we talk about having e-closings and bringing this electronic transaction forward, we really think about technology of having the ability to streamline the process and provide more uniformity in the information, as well as reducing the duplication of the documents that are signed during the process, and really providing consumers more time to review and understand and ask the questions that they need to have asked before they go through the process that's involved in getting a mortgage and purchasing a home. So as we talk about improving the consumer experience, what it really means to us is understanding. That's what's going to improve the consumer experience. And we know that it's very important for the home buyer to have the ability to interact on a personal level as well about questions that they actually now have a little bit more time to understand what those questions may be. And so for us, it's remembering that people aren't buying the home from a computer, and that they shouldn't feel like that throughout the process. And we want consumers to know about the documents received, the status of the transaction, so really what's already happened and what has left to be happened in the transaction, and then also have the ability to understand what they're agreeing to in the contracts. So technology should enhance and not replace the personal interaction that the settlement professionals provide to the home buyers. So when you think about the home buying process, remember it's a complicated transaction that's culminated in an event. And that closing as an event is really an action force in the event. And so because everybody knows that the home buyer is going to be at the table sitting across from a real estate settlement professional, they've got the ability to get documents signed. So from the lenders to the homeowners association, everyone's giving the settlement providers those documents so that they can get those documents signed. We think that with the technology being brought in to have more of electronic documentation that can be provided to the consumers earlier on in the process, instead of everything happening at that moment, they're going to have a better experience and feel much more empowered. So the idea is that you're not coming to a closing looking at a stack of 150 pages, knowing that 60 of those pages require a signature, and you've got a limited amount of time to do that, when what people are really thinking about at that moment in time is where's the couch going to go in the living room? So the other thing that we think about a lot when we think about electronic closings is how the documents are received, how those documents are signed and returned, and then how those documents are retained. So when we go through this process, we want to make sure that we think about technology from the perspective of the home buyer and seller. So how's the technology interface with them? And one bit of information that we've taken into account, the Houston Association of Realtors did a survey, and they found that 92% of the respondents would prefer to use an online tracking tool to get the status of their transaction. So I think that this tells us that consumers do want more technology in the process, but we need to think about what technology they want. They want technology that gives them more information about what's happening. And so all of that information should really be designed with giving the consumers the ability to feel empowered about their transaction and have more knowledge of the process. Buying a home is exciting. And we should keep this as an exciting, positive experience. And the more that we can streamline, provide uniformity, and really eliminate duplication, the more positive the entire experience is going to be, and people are going to be happy to get in that home and really decide where that couch should go. So thank you.
Thank you. Thank you, Michelle. And finally, Quintus Williams, please.
Good afternoon. I'm Quintus Williams, and I'm the Executive Vice President of Operations at Long & Foster Settlement Services, excuse me, and I'm here representing the National Association of Realtors. I've been with the company now for about 8 years, and in my current role, I direct more than 60 locations in 7 states and Washington, D.C. I'm responsible for operations, I'm responsible for technology, and for system development, and that involves a variety of tasks, but most notably identifying ways to simplify and streamline the settlement process for consumers and for our organization as a whole. As you may already know, Long & Foster Settlement Services is part of the Long & Foster Companies, which is the parent of Long & Foster Real Estate. We're the _1 privately held residential real estate company in the United States. In 2013, we sold more than real estate sold more than $28.3 billion worth of homes and helped people buy and sell homes more than 80,000 times, all utilizing technology. Long & Foster Settlement Services achieved similar success last year. We helped more than 20,000 consumers get to the closing table, and we do that better by using technology. Over the years, Long & Foster has helped millions of consumers through successful real estate transactions, and the company's ongoing success is truly a credit to both our customer service and our focus on providing consumers and our clients with a total homeownership experience. Not only do we offer real estate and settlement services, Long & Foster operates a corporate relocation division, property management firm, insurance agency, and mortgage banker, all heavily consumer-focused and reliant on technology. Thank you.
Thank you. Thank you once again to all of the panelists. As you see, we have a large panel today. I think we wanted to show just how complex the closing process was and how many players there are in the process and how many things need to align for all of this to happen. So thank you once again for all your perspectives. And I think you'll find that most of your points that you've outlined and highlighted today, not to put in a plug for our report or anything, but they're included in our report that we released today. So we all look forward to hearing your perspectives and your thoughts on that. So with that said, I'll continue and ask a few questions from the panelists. Some of the questions I'll ask to several of you. So the first question is to both Christos and David. We'll start with Christos. From the passage of e-sign to the early work by the GSEs towards getting to the first e-note, you each played a key role in these efforts. Tell us a little bit about the path taken in moving the industry towards greater adoption of e-closings.
Thanks. I kind of alluded to this in the beginning, and it's great to hear all of my friends and colleagues up here. There's always a reason why not do it. There's always a risk identified, whether it comes from the legal or the operation or somebody who's really busy, or there's 3 other higher priority projects. I think one of the things we discovered earlier on in the success is that this needs to be an executive, strategic, aligned objective. So to the extent I think that the CFPB can have conversations with senior executives at lenders to make this something that is aligned with the strategic objective of the lenders, you will have a much higher success of identifying pilots, because at the individual department level, there's always something else going on, but it needs to be aligned like that. I think I also want to add, because we didn't really talk about this, I want to recognize some of the servicers who have stepped forward in putting some great initiatives on electronic signatures and making the process of signing loan modification agreements electronically, making that process a lot better and cleaner for consumers. So this is an area where it was easier for some servicers and lenders to step in, didn't have to deal with all of the regulatory or investor requirements. So it is possible, and it can have success, and we've seen some examples of great successes. Definitely, that's how I would advise maybe the Bureau to approach conversations with pilots.
David, anything to add?
I think what I would add concerning kind of the history of this and what we learned early on was that shortly after e-sign was passed, there was a significant effort in the mortgage industry to start to move in this direction. Freddie Mac and Fannie Mae, for example, worked very cooperatively on changing the uniform notes in order to make it possible for them to be executed in electronic form and to take into account the new rules that were put in place in e-sign and the UETA. Freddie, in particular, early on also established a set of what I would call outcome-based or behavioral sets of standards for, as they started to realize that in order to have an effective electronic transaction, there was a need to assure that the processes and the systems were, to Margot Saunders' point, developed and designed in such a way that they actually enhanced the experience and they enhanced the delivery of information. And so you saw early on this rapid movement that then essentially slowed down as it hit the reality of the fact that there are a large number of participants, in particular parts of the industry, in particular when you look at things like appraisals, settlement professionals, they are extremely fragmented, which is not a bad thing, but it means that it's hard to get to any kind of uniform process. And we started to appreciate, as we worked with electronic records and signatures in other areas, that uniformity of process and interoperability, compatibility of systems was going to be a major, major element in getting to an effective e-closing. And now what we've had is, I think, over time, a whole series of fits and starts trying to get there. And the key, I think, to what's happening today is perhaps we are having a reset. And we're having the industry, as the group you see here, the folks in the audience, folks watching, the regulators who are present today saying, we think we see that this is the moment. Hopefully now we can start to move together as a more unified group. And I think based on our history, that's going to be very necessary in order to get there.
Thank you, David. We'll now ask a question of the GSE. So if Ann Epstein and Michael Cafferkey can answer, we know that there's an appetite to move towards e-closing. We've heard it again and again, and many have expressed concern that the GSEs are the only purchasers of e-notes. So what have Fannie and Freddie done to promote wider acceptance of e-notes and/or e-mortgages and the overall use of technology in the closing process? Let's start with Ann.
Okay, so, I think we talked a lot about kind of some of the early work we did, and I will say that we have been purchasing e-mortgages continuously since 2006 after publishing a guide that was really intended to ensure that lenders could feel comfortable that what they were producing was a truly enforceable, fungible note, really taking a lot of the legal pieces of e-sign UETA and how would you operationalize that? So really working with customers on how to do that. That said, we talked a lot about that, and what I actually would want to talk about more is some of the things that Meg was talking about. We learned a tremendous amount when we took a slightly different angle, not so much on the note, but thinking about the appraisal form, which had been a paper-based form used by the industry, similar in nature to a lot of things. There are a lot of appraisers, AMCs, many participants, not quite as many as the entire closing process, but still quite a lot. And we learned as we published data standards at the direction of our regulator, FHFA, to publish the Uniform Appraisal Data Set, that there were certain challenges we needed to overcome. We needed to ensure that people got used to new processes, new standards associated with the data set. But you can't have, it's not like paper, where, and I always use the example, you can go down to the archives and it's accessible for us all to see the Declaration of Independence. We can read it, I can read it, it's 200 years old, we can all read it. But electronic data isn't like that. I can't access files that I created 15 years ago. Well, you have to be able to access documents that were created 30 years ago. We all have to be able to do that because you want to make sure that that note or any other document is something that you could sell, is something that you could transfer, that the servicing can go any place. We can all access it in a certain way. And so data standards and accessibility to the documents become very key. And our work on the uniform appraisal data set and actually taking and then requiring that to be sent to the GSEs that data set through the portal, that became a method for us to learn how to move forward on things like the closing disclosure. And I think that we can learn from that, and the industry learned with us how to use XML, how to all access it, how to speak MISMO, a new language, a new way of accessing that I believe we can leverage with other documents that will eventually get us to that point. With that, I guess I can turn it over to Mike and talk about some other pieces.
Thanks. So actually, let me start by dispelling a myth, because I get this question a lot where people say the GSEs are the only ones that are purchasing e-mortgages at this time. And actually, two of the lenders that deliver to Fannie that are the largest, our largest deliverers of e-mortgages are also purchasers of e-mortgages as well. And so there are probably 40 to 50, maybe more correspondents that are out there that originate and sell e-mortgages to those lenders as aggregators, that some of which come into to the GSEs. So there are other lenders out there, or other investors out there, as well as others that I think are on the cusp of getting out there. I mean, certainly there are large investors out there that have yet to get on board, and so I think that'll be important as more investors get involved. But certainly GSEs are not the only ones at this point, and there are although it's limited, and so I do understand that the limitations on the number of investors is a factor in terms of lenders that are looking at e-notes. In terms of promoting adoption, so Fannie Mae is very committed, and I've been living and breathing e-mortgages now for, again, 8 years. The company is very committed to working with our customers in order to make a transition over to an electronic process, lead closing e-mortgages, and so forth. And so a big part of our strategy is really through engagement, and not just lenders, through closing agents, through realtors, through warehouse lenders. I mean, we're out there talking to folks, because part of this is really just about demystifying what e-mortgages are, what e-notes are. So there's a really important aspect of this is really just educational. And so a big part of what we do is really just provide education to our customers and let them know that we're there, we're their partner when they're ready to make that move. So that's the first thing. I think we certainly feel strongly that technology vendors are very key to this transformation. And so we've got a very strong partnership with our vendors. And in fact, last year we conducted an exercise at Fannie Mae where we brought together a group of technology vendors to work collaboratively on some of the real challenges that we see in the mortgage industry related to IT. And one of those challenges was related specifically to e-mortgage. It was a fabulous exercise. The dialogue and the ideas that came out of that were really tremendous. And that's really just one example of how we engage and work with the technology community and our vendors to try to solve some of these problems. And as we identify issues, we certainly are looking for short-term and also long-term strategies for helping mitigate and resolve those issues. One of the issues that has been around for quite some time that's kept some players out is the lack of support from the warehouse lending community to lend on e-notes and accept them as valid collateral. We've worked with a warehouse lender in order to devise a process that got them comfortable with the risk in the process, and we're able to roll that out and be able to include warehouse lenders in the e-note process. And so, we're constantly looking at challenges and looking at, in the short term, how we can address them, and then in the longer term, what the ultimate solution should be. And finally, we're constantly looking at our requirements, getting feedback from the lender community, but making sure that as technology evolves, that our requirements are appropriate and reasonable and not really viewed as being an impediment to progress. And so that's something we're constantly looking at. So, the message that we put out to our customers is really that we're open for business for e-mortgages, but we're a valuable partner and a valuable resource for you when you're ready to make that leap.
Thank you, Michael. And the next question will be for Stephanie Shader from Ginnie Mae. So FHA announced in January that they're now accepting e-signatures, and we heard a little bit more about that today on loan documents. What is Ginnie Mae's role in the adoption of e-signatures into the closing process?
Thank you. As Trish alluded to earlier, the FHA has come out and they're accepting electronic signatures on a vast array of documents, but not the note just yet. And that was actually a nod to us as we need to take some time to figure out how that's going to work within our program. Just to step back a little bit, I'm a relative newcomer to the group. I've only been involved in e-signatures for the last couple of years, and I feel very fortunate to be, frankly, piggybacking on a tremendous amount of progress that's been made over the last dozen years or so. And dealing with the technology standards that are used to create these documents, to store these documents, to maintain their liquidity and negotiability. And what we're really working to do is integrate that into our program. Our process is all paper-based now, and so we're thinking through what are those requirements? What does the eVault world look like? How does that fit within our program? And we're working toward getting that guidance out in relatively short order. I can't give any kind of deadline. But I'd also like to say that while our focus isn't really on the e-closing, which is really the focus of today's forum, we are supportive of that. There are a number of new rules and a number of things that have come out from the housing finance agencies, from the CFPB, and lenders are working very, very hard to comply. And I think we feel that the electronic disclosures and things really facilitate that compliance. I think they also have the potential to be a significant benefit to the consumer experience as well. It gives the consumer time to review these documents. And having been an originator in a past life, that's a pretty critical element too. So that's what I have.
Thank you, Stephanie. So the next question will be from David Whitaker. So this past summer, we went on a road tour. Ryan Webster and many of the people, Kim Teddy in this room, listening to a lot of these perspectives. And one of the things that we heard a lot over and over again were concerns around e-signatures and mortgages and how the legal challenges around e-notes. Can you speak some more about those concerns?
I can speak largely to the extent of expressing with respect to one of the two buckets, mystification. You really have to separate the legal issues around e-notes into two buckets. The first bucket is about enforceability of the note as a debt obligation. And in that respect, you have to bear in mind that actually there are several 100,000 e-notes that have been executed and put in place with respect to mortgages in the United States. And sadly, a certain number of those have gone to foreclosure. And the reality is that as a practical matter, enforcement of those notes has been no more difficult or no more complicated than enforcing any other mortgage note down at the courthouse. There have been a couple of specific things I think to note. There have been a few jurisdictions in which there's been a little confusion about how to handle the delivery of judgment, because in some states they had what they call the note surrender rule, which is that the original negotiable promissory note was supposed to be surrendered in return for the judgment. And there have been cases where there's had to have been a little education at the courthouse about, how, in fact, you come to cancel an electronic promissory note, and there really isn't anything per se to surrender. The other thing, though, that I will say is there's been a lot of question about the whole issue of integrity of the records, and while I think those are valid, I also think you have to bear in mind that in the mid-1990s, the federal and state judiciaries consciously reformed their rules of evidence in order to address the evaluation of the integrity of electronic records. And they've been doing it now for 20 years on a regular basis under those rules. If you actually look at the cases we have where the courts have either looked at electronic business records and either accepted them or rejected them, for the most part, the courts have proven to be very sophisticated and very perceptive about where the line is between a reliable record with integrity and a record that should not be relied upon. They're very good at it. And so I think we can say with respect to the first bucket that there's a fair amount of concern still out there, but it's not clear that a lot of that concern is justified. The second bucket is the bucket related to the free and rapid transfer of the debt obligation, which is a backbone on which the American mortgage market rests. A lot about how inexpensive it is to get a mortgage loan in the United States has to do with that free transferability. And there were all sorts of rules out there. There are all sorts of rules out there about how to preserve that free transferability with respect to paper negotiable instruments. When e-sign and UETA were drafted, there were rules put in place to attempt to create an electronic equivalent to that free transferability. Those rules, unfortunately, were created in a vacuum, and they were partly created by a couple of law professors who weren't too sure they liked the idea. As a result, they can be something of a challenge sometimes to work with, but they are workable, and they can, in fact, function. But they do require more attention to interoperability, and they require careful attention to certain specific characteristics of the note and how the note is treated. And that has slowed down adoption to a certain extent because there is no, at this point, we have no reported cases interpreting those rules. So we know what we think they mean, but we are still in a position where we do not know whether or not American courts fully agree with us about what they mean. And I would say that that is another area where potentially moving forward, this kind of collaboration between industry, regulators, the agencies can help to provide the level of confidence that the investing part of America is looking for in taking these in the same cheerful way they've been taking paper negotiable notes with 400 years of jurisprudence behind them. So that's kind of where I see the legal situation on e-notes being.
Thank you, David.
Uh,
I'm trying to stay inside the 2 and 3, thank you.
Appreciate it. And along those lines, going to ask another question of Anne and Michael. What do you see as some of the most significant barriers to more broad adoption of e-closings? I know we've covered that throughout this forum, but if you want to have it, if you have anything to add.
Yeah, let me just touch on a couple of additional points. I know we talked about, the primary thing that continues to come up is around liquidity and saleability, with the limited number of investors out there. And certainly that will continue to be an issue until there's, broader investor involvement and more the ability to sell to who you want to sell to, not just the note itself, but even the servicing. The secondary marketing folks don't like to be constrained in terms of their execution options. And so as we work with lenders to implement, probably for every 4 lenders, or for every lender that implements, we've got 4 or 5 that, as the more they learn about the process, the more they kind of back away, and that's one of the primary concerns. Also touched on the warehouse lender issue, but certainly the mortgage bankers that rely upon warehouse lender funding to have been somewhat constrained in their ability to implement an e-mortgage process because a lot of the traditional warehouse lenders have been unwilling to participate for a number of reasons, some of which are valid, and I think, again, some of which is just educational, and they just need to understand how their interest is perfected and how the process works. And so some of the pieces are in place, and maybe there are other pieces that need to evolve to support warehouse lending. A third issue that comes up is around the ability to get to a truly paperless closing. And so there are certainly lenders that they don't want to put a hybrid process in place where some things are wet signed, some things are e-signed. And in reality, a majority of the e-mortgages that have been originated to date are hybrid e-closings because typically the security instrument is still wet signed, traditionally notarized, and then often converted into an electronic format and submitted for e-recording. But the lack of electronic notarization capability nationwide has really kind of restricted the ability sometimes for that document to be wet signed or to be electronically signed and notarized. What we found in talking to lenders is that the recordable documents and the necessity to potentially wet sign those really doesn't diminish the value proposition from the lender's perspective. Those documents take a different route from the closing table, whereas most of the documents are going back to the lender or going to a custodian. The recordable documents get shipped off to the county for recording. They'll catch up later in the process. Sometimes, it takes, depending upon whether it's e-recording or not, it could take days, weeks, or even months in some recording jurisdictions, but it doesn't inhibit the ability to deliver that loan into the secondary market, into a security, and so forth. And so the hybrid process is still, there's a great deal of value from the lender's perspective, and we found that that's not a real huge issue. One other thing I think I mentioned previously is just the ability for the closing sector to support electronic signatures, electronic recordings. And I see great signs as we interact with the technology vendors that are in the e-mortgage space or that support the closing sector. I think that issue is moving toward resolution as well as those platforms are starting to develop those capabilities. So, I think those are the most significant issues. There are other issues that come up, many of which I think are more perceived than real issues. And as people understand and get educated, I think that some of those evaporate. But I think if we can address those real core issues, then we can really move toward broader adoption.
So, I think, Mike talked a lot about the issues, and what I want to just kind of summarize is this is a systematic, and we talked about all the players, and we talked a lot about some of the little more arcane things related to electronic signing, how to make sure that it's fungible, how to make sure that it's signed in accordance, that consumers are protected. All of those things are new processes for different parties and requires somebody with some expertise to make sure that they're interpreted correctly and done correctly so that we don't make the mistakes of the past where we run headlong into something without really understanding exactly what it is, and we all need to do it correctly in that way. And all that takes time, process change, and frankly, it takes infrastructure. And if every single party in that transaction needs to create infrastructure to be able to do these kinds of things, it's challenging. One of the examples that I think Mike did not use is the correspondents are selling to the aggregators, but often the aggregators will be the ones who put in the infrastructure for an eVault. If the correspondent can no longer sell that loan to an aggregator, they no longer have an eVault. Can every correspondent afford an eVault? How do we, as an industry, are able to move new processes, make sure that the people implementing it all have the right expertise? How do we make sure that there's shared cost in terms of some of this infrastructure that we need to move the industry forward so that we can bring other players involved, not just those who can afford the legal expertise and the expensive infrastructure to make sure that they don't lose those notes or that they're not enforceable because they're tampered with or any of those kinds of things. And so I think that there's some opportunity for us as an industry to move forward in putting in place some of that infrastructure to make that happen. And, I think that it will need to happen in order for all of us to move forward. And so, like I said, I think I'm looking forward to the transition and hopefully this from a standpoint is a restart and gives us an opportunity to really think about it in the context perhaps of the closing disclosure as a first step, and then how do we expand that out.
Thank you, Anne. The next question is for Quintus Williams. How has the realtor community adopted electronic documentation, and what are the advantages and disadvantages that you have found in using the technology? And how might this translate to benefits for consumers or lenders in the mortgage process?
Thank you. The couple of things. I think yesterday we were celebrating Earth Day. Am I correct about that? So paperless, environment is something that we need to talk about. But the realtor community, I think, as a whole, has adopted a number of electronic documentation processes, and I'm not going to go into all of them here. And they simplify the home buying and the home selling process for consumers, but they also save time or save paper, time and paper. real estate is very local. Some, agents still prefer paper, still people who prefer the fax machines. There's still, which I absolutely abhor. But there are a number of e-versions of contracts and documents that can be signed electronically. There's a number of vendors out there that are big players in the digital signature world. NAR has adopted DocuSign as their official e-signature solution for NAR members. There's a lot of better tracking capabilities, a number of benefits for keeping the information stored electronically, speeds up the whole process, a number of different things that are of benefit. A couple of constraints, if you will, to the process. I think someone mentioned it earlier, is sophistication, not only in the realtor community, but from a consumer standpoint. And there's I think a lack of consumer willingness in some cases, and someone else mentioned education. And then a huge barrier, I think, to is also negative publicity around security breaches. And, as an example, we had a transaction that was occurring yesterday, and one of the consumers absolutely refused to sign or to do anything unless it was in a paper environment. So I think that is part of the constraints that we have from a technology standpoint.
Thank you. And Margot Sanders, what do you see as some of the risks to consumers as the mortgage industry moves towards electronic closings? I know you spoke about that earlier.
So I have seen dozens, if not hundreds, of problematic mortgages. And included among those are many where the closings were conducted in Hardee's, in the back porch of a house with barking dogs and biting dogs, on the side of the road, on the highway. Those are typical problems in real-world transactions. So what those kinds of problems lead us to worry about are when there's an electronic mortgage, what assurances are there that the consumer, when he's sitting in the room with the closing, the person closing the mortgage, actually has consented to engage in this electronic transaction? Both eSign and UITA only work to allow electronic documents to replace paper ones when both parties have in fact consented. But eSign's consumer consent provision only kicks in for disclosures. It doesn't kick in for the contract. So a big concern we have is, how is that actual consent going to be reflected when the people are sitting in the room? It's less of a concern there when the transaction is truly over the internet. Then obviously there has been some consent on both sides. Another issue is when you look at the cases that have come down in the last 10 years interpreting what an electronic signature is, there's a real confusion in the courts over who has the burden of proof when the person whose signature purports to be electronically signed to a document says, that's not my signature. And that leads us to, and when you look at the FHA language even, there's a requirement for some protection of some protection of the sanctity of the signature, but what the degree of that protection is not made clear. It's not set out. So, it's perfectly potentially legal under some electronic signature regimes for the signature to be a voice saying, I agree, or a click, I agree, or a PIN, which we all use the same PIN, or many of us use the same PIN over and over, or a shared secret, which most family members generally know the answer to. So a forgery, which we see unfortunately in the predatory mortgage world quite often, seems too easy to be created in the electronic world unless there are some real standards to protect against it. Paper copies. When I'm sitting in the closing agent's office and I have an e-sign, an electronic closing, do I walk away with paper copies, or am I guaranteed some way in the future that I will always be able to access these different electronically created records? What if I'm one of that group of 45% of families elderly families who don't have access to the internet. How am I going to access my paper copies in the future? And the reason I care about this is I can't tell you how many cases where we have shown the documents in the consumer's file and the documents in the closing agent and the lender's file are different. They're different. And guess who made those changes? It wasn't the 65-year-old lady living on the south side of Chicago. It was the mortgage broker. So we need access to those documents in a way that we really know how they can be used and proven in court. eSign and UITA allow for the creation of a single authoritative document in this world. But what is that? I keep hoping I'll go to a forum and I will hear more about exactly how that will be created. Even FHA's e-signature guidelines talk about changes that can be made in an audit trail. Well, how authoritative is that document if there are changes that could be made? Who is it that makes sure that the changes don't change the meaning of the document? Again, I remind you of the situation where I've got two documents. Mine says one thing, and the mortgage lender says another. So we're very concerned about that. I'm sorry to be the naysayer. I think go for it, but please beware of the potential for fraud.
Absolutely. Thank you, Margot. And the next question is for Michelle Korsmo. I'll kind of combine two questions into one for you. If you can speak a little bit more about how technology and electronic documentations in the settlement and title space translates to benefits for consumers or lenders in the mortgage process. And I know that I don't know if you could speak a little bit. We highlighted in our report the PREA numbers that 65% of consumers live in counties that currently have e-recording capabilities. What are some of the obstacles that you've heard the counties face towards integrating e-recording capabilities?
Sure. So to answer the first question about how consumers and lenders can benefit from much more of an electronic transaction, I think the best thing is that without a whole stack of papers and kind of one moment in time that is that action forcing event, if you're able to pull apart the process a little bit before you get to that moment of closing, the borrower, especially the home buyer, is able to focus on what's really important. And we think that the forms that were created by the Bureau throughout their integrated mortgage disclosure process on the RESPA TILA disclosures are really going to go a long way in helping that effort, because all of the relevant information really is in that first page, if not the first 2 pages of both the loan estimate and the closing disclosure. So that's a great thing. And I think as we talk about all of this, we're really talking about changing the process. We're changing the process as it gets to implementation of the new forms. We're changing the process as it's talking about making, from beginning to end, it be an electronic transaction. And so with that, having the consumers be able to focus in and see very clearly what's the most important, and then have more time to look at all of the documents and do so at their convenience, takes a lot of the stress away from the process. And that, being able to pull the stress away from that closing table is one of those things that will give the consumer the understanding, or at least the ability to ask the questions if they want to ask them, and have a sense they have a greater understanding. And that greater understanding just will, I think, entirely enhance their experience. So,
and I'm unfortunately going to, just for the interest of
Sure.
time, I'm going to have to skip the e-recording
skip
question.
the recording.
Yes,
The
I'm so
recorders,
sorry.
the recorders of America are going to be disappointed.
I'm so sorry.
But I will say, just quickly, that I think that, while it's 60% of the country is able to experience e-recording, they do, through PREA and the recording efforts, they do spend a lot of time trying to figure out how to get to that process. And I think as all of this moves forward, the recorders will definitely be there to be a partner in that process.
Thank you. And Amy, if you can briefly, I know that your credit union recently made headlines by signing the first FHA loan with e-signatures. Can you tell us about your platform, how you came to develop it, and what some of the barriers were that you faced?
Sure. In 2010, we were given an initiative by our executive management at the credit union to make it easier for our members to do business. And so in the mortgage department, we started looking at ways that we could streamline our process, develop ways that would reduce the number of times members had to come in and out of our office. So we began a partnership with Stewart Title, and they came to us and said, you know, we're looking at moving forward with some e-closings. Would you be interested? So we actually started our process with the closing piece. So we had paper origination and then closed electronically. So we have been actually working on it since 2010. And so when some of the barriers that we had were just education. We had to educate our staff, our members. We did several road trips to title companies, to recording offices in the state of Utah, and just talked a lot about what our initiatives were and would they want to partner with us? Would they want to come on board and do business with us? Because this is the road that we were headed on. And we got a lot of people that were like, you're going to be the only person doing this in Utah. And we were. And but we forged ahead because it was the right thing to do for our membership. And we have had a lot of consumers and members tell us that they've enjoyed the process. They like the fact that they can review the documents at home. We survey all of our closings, each and every one, and just ask them, you know, what do you like about the process? Did you prefer the documents at home? And we've received a lot of information back from seniors and first-time homebuyers that first-time homebuyers have the ability to review all the documents and even have their parents come over and review the documents, ask questions. And so that's been really nice. Seniors like the fact that they're able to review the documents and then click to accept them. And then when they go into title, they're signing their name once. And it uploads to all the signature items. So that's been good. The barriers that we've had are what everybody's already talked about, the investors and just telling, you can't really tell your investors like you did your title companies if you want our business. But we've worked alongside, we sell direct to Freddie and Fannie, we sell to FHA, so we've actually had our process in place on conventional loans for a long time. We do a hybrid method where we sometimes have to wet sign the note and the trust deed. We have 7 counties in Utah that don't accept e-recordings or e-signatures, so we just wet sign the 2 documents. It's 2 wet signs versus 200. That's what we call it, 2 versus 200. And the borrowers seem to like it. It moves the processes fast. And we were so excited that FHA was willing to accept. That's why we were one of the first ones. We've been ready and waiting for them. And so we're happy to have it.
Thank you. Do you want it? Just everybody can have a round of applause for our panelists.
And at this time, I'd ask the panelists to please rejoin the audience. I'm especially pleased to introduce the next speaker. On January 26, 2009, Sean Donovan was sworn in as the 15th United States Secretary for Housing and Urban Development. He has devoted his career to ensuring access to safe, decent, and affordable housing, and has continued that effort in the Obama administration. Secretary Donovan believes that America's homes are the foundation for family, safe neighborhoods, good schools, and job creation. His tenure as HUD Secretary has reflected his commitment to making quality housing possible for every American. Sworn in at a time when the foreclosure crisis had devastated American families, under Secretary Donovan's leadership, HUD has helped stabilize the housing market and worked to keep responsible families in their homes. Secretary Donovan.
Zixa, thank you so much for a kind introduction. More importantly, thanks for everything you do here at CFPB. And speaking of which, I just want to say a very personal thank you to Rich Cordray. He has been, during his time as director, I think just a magnificent and courageous advocate, speaking out and standing up on behalf of families around the country. And Rich, you've been absolutely tireless. It is a great pleasure to have you as a colleague, as a partner, and as a friend. So let's give him a round of applause. No leader is great without a great team. And I want to say a real thank you to everyone at CFPB who has stood up an organization incredibly quickly and has accomplished really remarkable things. What you've done in really breakneck speed in Washington terms is a sight to behold. I know you had the mortgage industry's head spinning with all the new stuff you're doing very, very quickly. I hear it regularly, but it has really taken us from a place where we had a great risk to families and communities that we all lived through. And I feel like you've done more than anybody to make sure that we don't have a crisis like we've just come out of happen again. So to all of you here, congratulations. Keep shining that flashlight on the world out there. I was excited enough to come here, and I want to thank Amy for giving a shout out to FHA. Perfect transition. I was in New York today doing a bunch of meetings, and I literally cut short my trip, rushed to the airport to get back here, because I really wanted to be with you, because I think that these kind of discussions that focus on the role that consumer education can play in shaping healthy communities and a healthy housing market and economy overall are so important. And I wanted to start by quoting that great financier, Maya Angelou, who said, quote, "When you know better, you do better." And I dare say that knowledge is the most powerful tool a person can have when planning for their futures. Unfortunately, in the years leading up to the crisis, we all saw what happens when Americans are left in the dark. Too often, families were subjected to unethical lenders and other bad actors. Too often, they were confused by overly complicated mortgages and loans. And too often, we saw hardworking families who did everything right suffering the consequences of a mortgage market that was out of control. Obviously, this is not the way our market is supposed to function. Homeownership has historically represented a central part of the American dream. It served as a path to the middle class and helped families put down roots in communities. It's been a vehicle for families to build wealth, put their kids through college, start small businesses, and retire with dignity. It strengthened neighborhoods and bolstered our economy. And it simply isn't right that so many Americans who played by the rules saw their dreams turned into nightmares like we saw during the Great Recession. That's why all of us at HUD have been so proud to be a part of this Know Before You Owe campaign. I commend CFPB for all the great work it has done to simplify the mortgage process and to use technology to enhance the borrower's experience. And one of the things, Rich and I talk about this a lot, it is so important to find places where we can do things that improve the borrower experience, increase education, help them hopefully have a better shot at paying back that loan, but also make the process more efficient, lower cost, and simplify the work that industry does. There are plenty of places where there is a tension between consumers and industry, between knowledge and cost, but this is an area where those things aren't in opposition, and we've got to keep trying to find those areas. And we are committed to doing exactly that at HUD. Just an example that Rich and I talk about all the time, HUD's Office of Housing Counseling supports and regulates 2,400 independent nonprofit and government agencies providing housing counseling and education. Since 2009, our partners have helped 9.5 million families make better financial decisions for their future, or frankly, through the crisis, get through some very difficult times in the present. In fiscal year 2013 alone, we helped roughly 700,000 families take the first steps to avoid mortgage delinquency and foreclosure. Recognizing the success of this work, in our fiscal year 2015 budget, which was just unveiled a few weeks ago, the President's requesting $60 million for housing counseling, representing a 33% increase from this past year. At a time of tough budget choices, this increase shows how much the administration values the work that's going on here today. And that's why we're incorporating it into a lot of our other efforts. As many of you know, HUD's home to the Federal Housing Administration, which has long provided access to credit to those in underserved communities. And we want to ensure that the families we work with have all the tools they need to be successful homeowners. So we've started an effort we call Homeowners Armed with Knowledge, or HAWK. With it, we're working to embed housing counseling throughout the FHA origination and servicing process, allowing borrowers who commit to housing counseling to qualify for reduced mortgage insurance premiums. And this goes to what I just said a moment ago. This is better for consumers, more likely to be successful homeowners, lowers their cost. It's better for lenders because they're going to have fewer defaulted loans to service. And it's better for the taxpayer because it lowers the likelihood of default on FHA insurance. To remove the headaches our partners sometimes encounter when dealing with us, we took another step. Earlier this year, we announced that we're granting our lenders with the authority to accept e-signatures on origination, as you've talked about, servicing, loss mitigation, and other documents. This makes it easier to do business with us, and like CFPB, we'll continue to look for new ways to improve our efficiency on behalf of all the people we serve. Before I conclude my remarks, I'd be remiss if I didn't mention that we come together at an important time for all of us who care about sustainable homeownership. Just a few weeks ago, the Senate Banking Committee released important housing finance reform legislation that will expand access to credit to all potential buyers who are ready to own, build a rock-solid system that will ensure a crisis like the one we just faced doesn't happen again, and provides billions of dollars in funding for a National Housing Trust Fund and 2 other mechanisms to address critical needs like rental housing and down payment assistance. This is a once-in-a-generation, perhaps once-in-a-lifetime opportunity to make housing finance reform a reality. We cannot let a system which sent our economy into a tailspin, destroyed too many communities across this country to continue to endure. So I ask every one of you here today to make your voices heard about the urgent need for reform. 6 days and counting to the markup in the Senate Banking Committee next Tuesday. Please make your voices heard. I also ask that we continue to come together to promote education and empowerment. To paraphrase Maya Angelou again, when we know better, we do better. So let's do better by spreading the word about housing counseling. Let's do better by continuing to simplify the mortgage process for families. Let's do better by making housing finance reform a reality so that when families acquire the tools they need to be homeowners, they can access credit in a safe and stable market. These are all causes that we, as we gather today, that we share. We can advance them with hard work and persistence. Working together, I know we will. Thank you very much.
Now it's time to hear from the audience. The audience participation part of the forum gives audience members an opportunity for comments, insights, observations, and feedback about today's topic. So let's get started. Our first commenter is Mia Martinez. She's with the National Asian American Coalition. Mia, will you raise your hand? We'll move on to our second participant, Tim Rude with the Collingwood Group. We're going to get done very quickly today. Kurt Pfotenhauer, First American Corps.
Because you pronounced my name correctly, I felt incumbent to stand up.
Please pronounce your name for me.
Pfotenhauer, well done. So you did it well. I was hoping actually to ask a question when I signed up, and there's no one to ask the question of, so I'll turn it into a very brief comment. And that is that Director Cordray and those here representing the branches of the federal government that have a stake and an opportunity to control outcomes here, I hope you're also giving some real thought not only to organizing but to creating perhaps incentives for early adoption. You know, buyback risk, just for example, is an enormous issue for lenders. Potentially some relief for buyback risk for early adoption of e-mortgage. I think the number of things that can be solved if we could imagine the end state, would create an enormous list. We heard a lot of that list here today. It's going to be the complexity of spending the time and the money and the effort to hook up a lot of fragmented parts of the market to get to that end state that's going to be the real challenge. And that normally happens when there are incentives. Certainly, the need to comply more quickly, to manufacture a defect-free mortgage, to run data and analytics against what will be this vast new flow of information that we're able to generate with e-mortgages is in everyone's benefit. But we do, sir, I think probably need your continued leadership to really prod the market to move forward as quickly as technology will allow. Thank you.
Thank you for the comment. Ruth Susswing, Consumer Action.
Hi, I'm Ruth Susswine with Consumer Action. First of all, I would say that I'm really encouraged by everyone's participation in this, and it's been a very optimistic day. I do want to support Margot's comments about accessibility. It's essential that everyone be able to, if we're going to go electronic, that everyone have access to this, and that we consider language issues as well. And I also want to support what Amy said earlier, having to do with disclosure. The main thing I think that I'm encouraged by is the 3 business day opportunity for consumers. That's going to be essential because it will give people an opportunity to review the documents, as has been said, and allow others to advise them. And if there are problems, be able to address them. Because what we hear about from our hotline from consumers regularly, as recently as last week, are complaints that when it comes to the actual closing, there are still all kinds of changes that they're seeing. Consumers complain of interest rate increases, fee increases, forgeries, and the kinds of problems and then the pressure that they're receiving to sign on the dotted line that day is something that hopefully can be helped by the fact that people will have 3 days to review those documents, 3 business days. Thanks.
Thank you for the comment. I'm going to call Mia Martinez again. Perhaps she's rejoined the group. Tim Rude. Okay, that concludes the audience participation portion of the forum. I want to thank all the speakers and all the panelists. Thank you also to the audience commenters. The insight and feedback that you provide to the Bureau is important. We take it very seriously and we welcome it. I want to also thank all who watched via live stream at consumerfinance.gov. And that concludes the Bureau's Know Before You Owe Closing Time Forum. Thank you for joining us today.